Hi, and welcome to our end of April update from the Wealthy Doctor Institute. Physicians leading physicians through finance. We work with physicians and other busy professionals who are not happy with their current investment strategy. We help them get this part of their lives handled so they feel empowered and in control. I'm David Ye, and in my book, The Busy Doctor's Investment Guide, I show you just a few ways where just a few adjustments each year can help build and protect wealth. Although the strategies in this book are easy to calculate each month, for those of you who are new to the concepts of the book, or for those of you who are new to investing in general, this video will try to clarify what I do every month. Feel free to follow along every month until you get the hang of it. So for this month, we'll go over the Busy Doctor's update of the month, then we'll go over the topic of the month, then we'll go over our system starting with our 20-month moving average system, our MRI system, the rules for 25% stop loss system, and then monitor the free sector surfer strategy. So day in the life of a busy doctor. Even though I semi-retired 5 years ago, life continues to be busy. And this last month was no different. One of the highlights last month was that I got to help my son rehearse and participate in the annual Lantern Festival celebration, something that as a full-time physician I probably wouldn't have been able to support quite as much. And even though he's now technically a teenager, 13 years old, and he's discovering that he has his own life, still, time with family is still precious. Careers come and go, but you only get one chance to see your kids grow up. Plus also, I'm moving into a new studio, so this time next month you'll probably be hearing my video recorded in a completely different environment. So, despite the busyness, I still easily place the trades indicated by my systems. They literally require mere minutes to see and execute. Which leads to our topic of the month. Our topic of the month this month, usually I don't talk about this. Most people ask me questions, usually ask me about fundamentals. But this month, for some reason, there have been several people who have been asking me about technical analysis, which is great. This is something that I've cut my teeth with when I started learning how to invest. Now, you know my take. News out there, pundits, what CEOs say, what news say about politics and war and Ebola viruses and historic summit meetings between North and South Korea, they have little to no impact on the markets. And when looking at financial statements, unless you're really savvy at looking for ticking time bombs that can easily be hidden in the numbers, and unfortunately most people are financially illiterate, most people just get swept up by the hype. And even if you can read their financial statements correctly, stock-specific news, competitors who out-innovate and blindside the company, corruption scandals, changes in law specific to that industry or that specific company, these things can all adversely affect individual stocks. However, one thing that cannot be hidden is that every single trade in the market, every single buy, every single sell, leaves its footprint in the stock market chart. That's why technical analysis is where we're dealing with the raw data. And I'll show an example with our first trading system. So to review our systems, starting with the 20-month simple moving average. The rules are simple. If the price of the S&P 500 index is above the 20-month moving average, it's relatively safe to stay invested in this index fund. Otherwise, get out. Remember, this 20-month moving average rule is our safety belt. It only works if we watch it once a month. So here's a graphical representation of the S&P 500 index in blue compared to the red line, which is 20-month moving average. The VFINX is the Vanguard S&P 500 index mutual fund that I use to calculate this example. And the only reason I use the Vanguard fund is because it's the fund with the most data, dividend corrected. And at the end of April, the VFINX price was 244.72. Its corresponding moving average is 223.71. So if you take a look, both the S&P 500 index went up and the moving average went up. And if you divide, you get a 9.4% cushion, about the same amount as last month. So this is where I'm getting a lot of questions. People see this drop from February, and there's a lot of concern, understandably. Now, keep in mind, if you take a look at before, we had some pretty concerning drops back here in 2015, back in 2011. Never mind these big bear markets. We're not talking about these. We're talking about these little wiggles in the bull market that happens to cause us a little concern. But if you take a look at the grand scheme of things, we're still pretty high here relative to our safety belt. It has not met criteria for us to take any action, at least not this month. And this is true for other bullish indicators as well. Now, if you take a look at the monthly data that I'm plotting here, it looks like, okay, there was a tiny drop here and an even smaller pickup here. What if we take a look at the daily chart? So here's the daily chart. So just to orient you, here's January, here's February, here's March, so that accounts for that big down, and there's this little up in April. You can see that the downs have been more violently down than the monthlies implied. But then just as quickly as it went down, it went up again, and then went down again, then went up again, went down and up. Compared to 2016, where the markets were relatively quiet and relatively unidirectional with occasional wiggles here and there, this seemingly violent, technically choppy market, where choppy means up and down a lot, I can understand gives concern to people who are not used to trading different types of markets. But let me see if I can simplify this just a little bit. You see these lines that we can draw connecting these dots where the highs get lower, yet the lows get higher? You see how every time it drops, it seems to respect this line, at least for 2 dots. Over here, every time it climbs, it seems to respect this upper line. So you can see that with the tendency of prices to bounce around between these 2 lines, something has to give. Eventually, the markets will have to either make its decision go up or go down. And it doesn't make sense that in order for the markets to go up, it has to somehow violate this line that's been respecting for months. Same thing as if it was to crash, it would have to violate this particular line. So we can think of this triangle as our cone of indecision, where the markets are trying to decide whether or not to be bullish or bearish. And if you're thinking that, well, the markets are still listening to the news and that's why they're confused, well, they've been listening to news all last year as well. So for shorter term traders, they may want to look at these lines, but if you look at these lines, you notice that we're looking at this on a daily chart. That means you look at this daily. And unless you know what to do with this daily information, I would suggest not using this particular type of information in your own investing. For some of you more advanced traders out there, you're probably aware of this very obvious flag pattern. There's another technical word in the trading world called a flag. And it looks like the markets will have to make a decision sometime by June, mid-June. But until then, even if the markets make some kind of wild, premature breakout up or down, our mechanical systems will likely catch these trends as they develop. So the whole point of using technical analysis and other filters to try to organize this data into something interpretable. I knew early on as a radiologist that when we look at scans, whether it's ultrasound or MRI or CTs, the raw data is uninterpretable. The raw data must be processed with a mathematical algorithm. And even then, when we make findings, we don't attach emotion to our findings. The findings are what the findings are. And we can usually figure out what to do based on objective criteria and our interpretations. So keep this objectivity with the markets. So some observations for this month. The 20-month moving average indicator continues to signal relative safety in the U.S. stock market. Both the S&P 500 index and the moving average gained, but barely. So our safety cushion remains around 9.4%. Now remember, this system is not designed to catch peaks. No system is foolproof or perfect. In fact, for this particular system to switch, the markets must lose 9.4% by next month for us to catch this. And then upon closer look at the daily charts, we see that the markets will probably make a decision, either bull or bear, by as late as late June. So here's Sector Server's StormGuard armor Remember, StormGuard is another filter to see whether or not it's a relatively bull or bear market, relatively safe or relatively dangerous to be in the stock market. And right now, we're still in the S&P 500 index. So here's the indicator. The signal is drifting closer and closer to the zero line, but it has not crossed below the zero line yet, so we're still relatively safe to be in stocks right now. So our next system is the monthly rotation investment system, abbreviated to MRI system. The MRI rules, we just rank 3 mutual funds: the S&P 500 index fund, the emerging markets index fund, and the inverse S&P 500 index fund. Every month, rank which ones did best to which one did worse, and then sell the bottom 25% of our portfolio and buy the top fund. So here's how our system worked this month. Last month data, this month data. Subtract, divide, subtract, divide, subtract, divide, and we can see that there's a clear winner. This month is the S&P 500 index fund. Now, we saw from the last example that the S&P 500 index did go up a little bit this month. And here's how much it went up. Only 0.37%. In fact, this is so flat that if you take a look at the green and the blue lines, they cross each other several times because the US markets have been so flat. Meanwhile, the real loser is the emerging markets that lost 2.1%. So here's how we handle this situation. Last month, we were roughly half in the inverse fund and half in the emerging markets fund. This month, we're supposed to sell our loser and buy our winner. So we use 25% of our portfolio, we sell 1/4, and use that quarter to buy the S&P 500 index fund. Now, if you notice, one index fund and one inverse fund cancel each other's out. So what you might want to do, instead of selling one, buying another, just sell some of your emerging markets and sell some of your inverse fund, and now you're 1/4 in inverse fund, 1/4 in emerging markets, and half in cash. And this just makes entering the markets next month, if necessary, easier. It saves on commissions, especially if you're using ETFs. So here's Sector Server's version of rotating the MRI funds. Again, you're rotating these same 3 MRI funds using Sector Server strategy. And according to Sector Server, we're still in the emerging markets. We have not yet rotated into the S&P 500 index fund or the inverse fund. Now remember, these are 2 different ways of rotation. Don't mix them up. If you're using one, use one. If you're using the other, use the other. So the observations of the month. The markets have been fairly flat this whole month, at least the US market. That's why both the US market and the inverse fund barely gained and lost. But the US market still edged out, so that's why we're rotating to the US markets. And since 1 unit of S&P 500 index fund pretty much cancels out 1 unit of the inverse fund, we can have the equivalent position of 50% cash, 25% emerging markets, 25% inverse fund for this month. And the reason why we stay in cash is so that next month we can save on a commission just by buying whatever it is that we're supposed to be buying. And then remember, if you're using the Sector Server version of this strategy, the Sector Server strategy continues to be in the emerging markets. Don't mix up your systems. So our next system is the 25% trailing stop loss system. The rules are simple. If you really want to buy an individual stock for some reason, limit your risk of that one stock to 1% of your portfolio or trading account. That means if you use up to 4% of your trading account to buy that stock, you enter a 25% trailing stop loss order. This way, if your stock falls 25%, you only lose 1% of your portfolio. Now, if the stock goes up 33%, now your stop loss has basically broken even, and you can go ahead and use another 4% of your account to buy another block of stock, and then adjust your trailing stop to reflect the increased number of shares. And you keep doing this until you're eventually stopped out. The whole thing about this is that if your stock really is going to the moon, you're continuing to build up position in that stock with relatively little risk. However, if your stock more than likely goes down instead, at least you protect your account somewhat by only limiting your risk to just 1% of your portfolio. So the next system is using your own sector surfer system. And just to go over how sector surfer works, sector surfer has two main tools. It has something called Storm Guard Armor, which is similar to the 20-month moving average system in that Storm Guard Armor tries to figure out whether or not it's relatively safe or dangerous to be in the stock market in general. Tends to be more robust than 20-month moving average system, but trades more often. And then we have a sector rotation component, which is kind of like the MRI, only more robust. It trades less often than MRI, and can handle up to 12 funds, depending on what's in the universe of funds that you'd like to rotate through. Usually, for instance, in a 401k plan, they only offer so many funds, plug them in, and you can rotate them. Now, Sector Surfer is built so you can combine both the sector rotation and the Storm Guard Armor into one system. So here's how to do it. During bull markets, the choice of funds that you rotate through will only be using the stock funds or ETFs, and when it's relatively dangerous to be in the markets, use only bond funds or other non-stock funds or ETFs. And beware of other nuances that I've gone over before when constructing or executing your strategies. So if the sector surfer strategy is set up properly, you will get a signal through email or text. Now this month, there were a few strategies that did signal a switch. It's usually from one stock fund to another stock fund. I haven't seen any trigger to a non-stock fund yet. But if you have not received a signal, log in to make sure you didn't miss a signal. Technology isn't perfect. And sometimes we don't get our texts, or sometimes we don't get our emails. Sometimes it goes to spam folders. Sometimes it just gets lost. So since I did get some signals, I'm letting you know, check your system to make sure that you didn't miss any signals either, if you haven't already received yours. So let's review the free strategy that comes with your free sector server account. For this month, it remains in the safe for stock zone and no trade indicated for this free strategy. So here's what it looks like. This free sector server strategy that comes with your account rotates through these stock and bond mutual funds and rotates into cash when it's dangerous to be in stocks. This month it's still in their Fidelity Worldwide. So in summary, what we cover in this video, a brief look at basic technical analysis, and even though the markets have been extremely choppy the last 3 months, if you draw some lines to make a little bit sense of where the footprints in markets are taking us so far, a new trend may emerge as late as mid-June. So you can either keep an eye out for it, but if you do, make sure you know what you want to do when it breaks out, or we'll just let our systems use their own criteria to direct our trades. We covered the 20-month moving average system, no trade there. The monthly rotation investment system, there is a trade there. But if you're using a sector server strategy, there is no trade there. Dealing with stock tips, and the sample-free sector server strategy. So keep those questions coming. I know I talk to several of you personally every month and realize that for some of you, these video updates are not enough, especially if you're still unhappy with your current investment strategy or lack of strategy. I'm going to offer a complimentary investment wellness checkup and breakthrough session. You can just schedule that by typing in this URL, calldavidA.com, and just schedule a slot that works for you. We can, if you're local, we'll just meet up somewhere. Otherwise, we'll just hop on a Skype session where we can screen share and I can talk to you more personally this way. During this session, ask all the questions you want, no matter how seemingly basic or clueless you think you are. Part of the whole learning process is owning that there are things that we don't know that we need to know. And then during our checkup session, together we'll work towards creating a sense of clarity about the financial future you really want, why you're investing in the first place, discuss the essential investing building blocks for your particular situation, determine what has stopped you from having the investment results you've wanted, Identify actions you can take right away that may move you towards the financial goals that you desire, and then complete the consultation with the excitement of knowing exactly what to do next to create the financial future you really want. Think CME, only topic is financial, and tailored to you. Think wellness checkup, because whether or not you feel financially well, if you had a financial cancer or a blind spot you didn't know about, wouldn't you rather at least know so you can deal with it before the problem grows and metastasizes? Don't be bashful reaching out. The more you delay, the more time is against you. So, until next month, invest safely.